Many people in America believe the IRS exists to take their earnings. But when you examine the actual tax regulations, you discover something remarkable. There are complete sections created exclusively to compensate you for making specific investments, not deductions, not exploits. The federal government actually gives you money when you place your capital into the things they want developed. I will demonstrate exactly which investments the IRS compensates you to make, the amount they compensate, the reason 90% of people in America never access a single one of them, and the way the affluent have silently been utilizing these approaches for the past 100 years to construct the type of generational prosperity that many people think is not achievable without being born into it. By the conclusion of this video, you will comprehend the tax regulations not as an instrument of oppression, but as an offering that lawmakers created exclusively to incentivize specific behaviors. And when you simply select the options from that offering, the IRS will compensate you to exist the lifestyle the federal government desires you to exist. Let me begin with the single most critical principle in the complete tax regulations, because when you comprehend this one thing, everything else becomes clear. The tax regulations are not created to be equitable, they are created to incentivize conduct. Every single line entry in the tax regulations was created by lawmakers to direct capital towards something. Residential property, power, commerce, investment, retirement, learning, giving. When you do what the tax regulations want you to do, the tax regulations will subsidize you. When you disregard the tax regulations and simply work a W-2 position and receive a paycheck, you pay the maximum effective tax percentage in the nation. The typical W-2 worker pays something between 25 and 37% of their earnings in federal obligations, state obligations, payroll obligations, and hidden charges. The typical affluent person in America pays closer to 15%, not because they have superior accountants, but because they comprehend the regulations are an offering and they selected from the correct part of the offering. Now, let me guide you through the investments the IRS actively compensates you to make. The first one is so straightforward, it makes people frustrated when they finally comprehend it. Launch a business. The moment you have a legitimate business, every economic relationship in your existence changes. Every laptop you purchase, every phone you utilize for work, every trip you take for a client, every meal you consume while meeting a prospect, every mile you drive between appointments, every subscription you utilize to operate your operation, every dollar you spend educating yourself about your industry, all of it becomes deductible. And I am not discussing some small percentage. Under Section 179 of the tax regulations, you can write off up to $1 million of business equipment in the same year you purchase it. A regular worker making $100,000 pays obligations on $100,000. A business operator making the same $100,000 can lawfully deduct tens of thousands of dollars in costs before the IRS ever sees a penny. That is not a manipulation. That is the tax regulations working exactly as they were created. Lawmakers want more small businesses in America. They created the guidelines so that the more you invest back into your business, the less you pay in obligations, and it accumulates over time. A business operator who invests aggressively in their operation can lawfully run at a paper deficit for years while actually constructing real equity and real cash movement underneath. That is the strategy. The second investment the IRS compensates you to make is property. And I want to spend real time on this one because this is where the affluent silently construct generational money. When you purchase a rental property, the IRS lets you deduct something called depreciation. Here is how it functions. The tax regulations assume that the physical structure of a building slowly deteriorates and loses worth over time. For residential property, the assumed lifespan is 1 to 2 years. For commercial property, it is 39 years. So the IRS lets you take the worth of the building, divide it by that number, and write it off against your earnings every single year. A $500,000 rental property with a $400,000 building worth gives you roughly $1,400 to $8,500 in depreciation deductions every year for nearly 3 decades. That is $1,400 to $500 of earnings that the IRS pretends you did not earn, even though you did. But here is the part that will astound your mind. The property is not actually losing worth in most situations. In fact, it is usually going up. So you are collecting rent, you are constructing equity, you are watching the property appreciate, and the IRS is still reducing your taxable earnings by tens of thousands of dollars a year based on a fictional depreciation that is not really occurring. This is called a phantom deficit. It is a deficit on paper that is actually a gain in reality. It is one of the most advantageous accounting arrangements in the complete tax regulations. Now, combine that with something called a cost segregation analysis. This is where a professional engineer examines your property and identifies every component that has a shorter useful existence than the building itself. Things like carpeting, appliances, light fixtures, landscaping, and parking lot surfaces. Those components can be depreciated over 5, 7, or 15 years instead of 27, which means you can front-load huge amounts of depreciation into the initial years of ownership. A smart investor with $1 million rental can lawfully claim $150,000 to $250,000 of depreciation in the first year alone. That is a massive deduction against active earnings if you qualify as a property professional. And then we arrive at the 1031 exchange. Section 1031 of the tax regulations says that if you sell one investment property and transfer all the proceeds into another investment property within a specific window of time, you do not have to pay a single dollar of capital appreciation obligation on the sale. You can do this infinite times. You can purchase a small rental, sell it, transfer the profit into a bigger rental, sell that one, transfer the profit into an even bigger one, and keep going forever. You never pay the obligation, and when you pass away, your heirs inherit the property at what is called a stepped-up basis, which means all those decades of appreciation are completely eliminated for obligation purposes. The federal government actually lets the affluent construct and transfer property empires without ever paying capital appreciation obligation on any of it. This is not unlawful, it is not a secret, it is written directly into the regulations. Most people simply never read the regulations. Now let me move to the third investment because this one almost nobody discusses. And when I explain it, you will comprehend why the affluent are so silent about it. Power. The federal government wants American power production. They want it so intensely that they created incentives so aggressive they almost sound fabricated when you first hear about them. If you invest in oil and gas through what is called a working interest, you can deduct between 65 and 80% of your investment in the very first year through something called intangible drilling expenses. Let me put that in real numbers. If you place $100,000 into the correct power project, you can lawfully write off up to $80,000 against your active earnings immediately. Not spread over years, not phased in, immediately in the first obligation year. This is one of the only investments in the complete tax regulations that lets you deduct against BYU earnings. It is exclusively carved out for this exact purpose. Because lawmakers want private capital to fund American power. And if you prefer renewables, the Solar Investment Obligation Credit gives you 30% of your installation expense back as a direct credit. I want to be very clear about what a credit is because a credit and a deduction are two completely different things. A deduction reduces your taxable earnings. A credit reduces your obligation bill dollar for dollar. If you owe the IRS $20,000 and you receive a $10,000 obligation credit, your bill drops to $10,000. It is direct money off the top. So if you install a $100,000 solar installation on your property, you receive $30,000 back, not as a refund of your costs, but as a reduction of what you owe in obligations. And you still own the solar installation, which generates electricity that either saves you money or gets sold back to the network. That is the federal government compensating you to own power production. There are also obligation credits for wind power, geothermal installations, battery storage, and even for purchasing certain electric automobiles. The Inflation Reduction Act, despite its misleading title, was actually one of the largest packages of power investment obligation credits in American history. It simply was not marketed to regular people. It was created for corporations and affluent investors who would know how to utilize it. And that is the theme of this complete video. The tax regulations reward people who know how to utilize them, and they disregard people who do not even know they exist. The fourth investment category is retirement accounts. And I know everyone has heard of retirement accounts, but almost nobody utilizes them correctly. A regular 401k lets you defer about $23,000 a year. In 2025, that is the standard worker contribution limit. But here's where it gets interesting. If you operate a business, even a small side business, you can open a solo 401k and contribute up to $69,000 in a single year. That is 3 times the limit of a regular worker account. You are contributing both as the worker and as the operator at the same time. And every single dollar of that contribution comes directly off your taxable earnings. A business operator making $200,000 can contribute $69,000 to their solo 401k and immediately reduce their taxable earnings to $131,000 at a 32% obligation bracket. That is over $22,000 in obligation savings in a single year every year for the rest of your career. And then there is the ultimate treasure of the complete retirement framework, the health savings account. The HSA is the only account in the complete United States tax regulations that gives you a triple obligation advantage. Money goes in tax exempt. Money grows tax exempt. Money comes out tax exempt when utilized for qualified medical costs. There is actually no other account in the complete regulations that gives you all 3 of those benefits at the same time. Traditional 401k gives you tax exempt going in and tax exempt growth, but you pay obligations coming out. A Roth IRA gives you tax exempt growth and tax exempt coming out, but you pay obligations going in. An HSA is the only one that gives you all 3. And here is the detail that almost no one utilizes. You do not have to withdraw the money for medical costs at the time you incur them. You can pay medical costs out of pocket, keep the receipts, let your HSA grow for decades, and then reimburse yourself later at any point in the future. Which means the HSA can secretly function as an additional retirement account with the optimal obligation treatment of any account in existence. Now, I want to go beyond the 4 main categories because the tax regulations are full of smaller, lesser-known approaches that can layer on top of each other and multiply your savings. Let me guide you through a few of the ones the affluent utilize that almost no one discusses in public. First, opportunity zones. This was established in 2017, and it is remarkable. If you take capital appreciation from any investment, equities, property, cryptocurrency, business transaction, and you reinvest those appreciation into a designated opportunity zone fund, you receive to defer the capital appreciation obligation on the original investment until 2026. And if you hold the new investment for 10 years, every single dollar of appreciation on the new investment is completely obligation exempt forever. No capital appreciation obligation at all on a 10-year hold. This was created to direct private capital into economically distressed regions, but the affluent have utilized it to construct multi-million-dollar obligation-exempt investment portfolios. Second, the Augusta principle, which is Section 280A of the tax regulations. This is a principle that says you can rent your personal residence to anyone, including your own business, for up to 14 days per year, and collect the rent completely obligation exempt. Not reduced obligation, not lower obligation, zero obligation. If you operate a business and you hold quarterly meetings at your own residence, you can compensate yourself $2,000 a day in rent, claim a full business deduction, and personally collect $28,000 a year obligation exempt. It is one of the simplest and most underutilized approaches in the complete regulations, and it is completely lawful as long as the rent is reasonable and documented. Third, employing your children. If you operate a business and you have children, you can compensate them a reasonable wage for actual work performed in the business. Under current guidelines, children under 18 working in a parent-operated business do not have to pay payroll obligations. And if their total wages stay under the standard deduction, they pay zero federal income obligation on those earnings. So you shift earnings from your high obligation bracket to their zero obligation bracket, receive a full business deduction on the wages, and transfer prosperity to the next generation while they learn real abilities. A family with two children can lawfully move $30,000 a year off the parent's obligation return. This way, fourth, qualified small business equity, which is Section 1282. If you invest in or establish a qualifying small business and hold the shares for at least 5 years, you can exclude up to $10 million of appreciation from federal obligations. Not reduce, exclude completely. This is one of the reasons so many technology founders pay almost no obligation when they exit. They qualified under Section 1202, and the first $10 million of their appreciation is eliminated before the IRS even gets to see it. Fifth, the step up in basis at passing. When you pass away, your heirs inherit your assets at the fair market worth on the day you passed, not at the price you originally paid. This means all the capital appreciation you built up during your lifetime disappear completely for your heirs. Someone who purchased equity at $10 a share and watched it grow to $1,000 a share over 40 years can pass that equity to their children with a brand new basis of $1,000. When the children sell, they owe nothing in appreciation. This is how generational prosperity accumulates without ever being taxed. Sixth, the Roth conversion sequence. You take money from a traditional IRA, pay the obligation on it during years when your earnings is low, convert it to a Roth IRA, let it grow obligation exempt for 5 years, and then withdraw it completely obligation exempt. Utilized correctly, this lets high earnings earners construct obligation exempt retirement accounts, even though they were technically above the direct Roth contribution limit for most of their working existence. Seventh, the research and development obligation credit. If your business spends money on developing new offerings, improving existing offerings, testing new procedures, or constructing custom software, you can qualify for a federal obligation credit that can be worth up to 20% of those costs. This is not just for pharmaceutical corporations or semiconductor manufacturers. A small software corporation, a custom fabrication shop, a food and beverage corporation developing a new recipe, an engineering firm designing custom solutions. All of them can qualify. The typical small business operator does not even know this exists. The typical obligation accountant does not know how to claim it properly, but the corporations that do know have lawfully shifted tens of thousands of dollars per year out of their obligation bill and back into their own accounts. Eighth, the backdoor Roth IRA. If you make too much money to contribute to a Roth IRA directly, you can still lawfully get money into one. You contribute to a traditional IRA on an after-obligation basis, then immediately convert it to a Roth IRA. This is completely lawful. It has been approved by the IRS in published guidance. It lets high earners construct obligation-exempt retirement prosperity that grows completely outside the reach of future obligation, increases every single year. You can do this every single year. Most people who could benefit from it never even hear about it. Ninth, the Mega Backdoor Roth. This is the advanced version of the regular backdoor Roth. If your employer offers it, you can contribute up to around $46,000 per year into a Roth account on top of your regular contributions by utilizing after-obligation contributions that get converted or transferred. This can accelerate your obligation-exempt retirement account by hundreds of thousands of dollars over a working career. It is one of the most silent advantages in the complete regulations, and it only exists for people who bother to ask their plan administrator whether it is available. 10th, historic rehabilitation obligation credits. If you purchase and restore a certified historic structure, the federal government gives you a 20% obligation credit on the qualified rehabilitation costs. That means if you spend $1 million restoring a historic property, you receive $200,000 back as a direct reduction of your obligation bill. Combine that with depreciation, cost segregation, and property professional status, and you can lawfully construct a property empire around historic properties while paying almost nothing in obligation. 11th, affordable housing obligation credits. This one is not for the typical person, but if you have the capital to invest, the federal government will compensate you directly for constructing affordable residential units. The credits can be worth up to 9% of your qualifying investment every year for 10 years. That means the federal government effectively pays back 90% of your investment in obligation credits over a decade while you still own the property and collect the rent. This is why the largest private investors in affordable housing are insurance corporations and affluent families. They comprehend the mathematics. 12th Section 529 plans with Roth conversion. Starting recently, unused money in a 529 education savings plan can be transferred into a Roth IRA for the beneficiary up to $35,000 in total. So even if your children do not end up utilizing all the money you save for their education, it does not get lost. It gets converted into an obligation-exempt retirement account in their name. You can front-load a 529 plan early in a child's existence, let it grow for 18 years, pay for their education, and then pour the remainder into their retirement account. That is intergenerational prosperity transfer with obligation-exempt growth at every single step. Now let me guide you through an example that shows how these layer because this is the part that changes how you think about money forever. Imagine you are a business operator making $250,000 a year without any obligation planning at federal plus state plus self-employment obligation rates. You are probably handing between $80,000 and $90,000 to the federal government every year. That is more than 30% of your complete gross earnings gone before you even get to exist your existence. Now let me guide you through the same person utilizing the approaches I just described. You place $69,000 into a solo 401k. You place $8,000 into a health savings account. You purchase a $300,000 rental property and claim roughly $10,000 in depreciation. You do a cost segregation analysis and front-load another $30,000 of depreciation in the first year. You compensate your teenage children $12,000 each for real work in the business, moving $24,000 off your return into their zero obligation bracket. You place $100,000 into a carefully evaluated oil and gas, working interest, and deduct $80,000 of it. You utilize the Augusta principle and collect $28,000 in obligation-exempt rent from your own business. Add up the deductions. You just lawfully eliminated around $240,000 of taxable earnings. Your effective obligation percentage drops from the mid-30s into the single digits. You just place somewhere between $50,000 and $70,000 back into your own account in a single year, every year forever. All of it lawful, all of it documented, all of it created into the regulations by lawmakers, and that is just year one. Now imagine that same person layers those approaches year after year. The rental properties grow in quantity. The retirement accounts accumulate in an obligation shelter. The HSA grows into a hidden medical reserve. The children grow up with real work history and real Roth accounts in their own names. The business becomes more valuable because it is being reinvested in aggressively. 10 years from now, that business operator has somewhere between $1 and $3 million in additional net prosperity compared to the version of themselves that did nothing and just paid the standard obligation bill. That is not theoretical. That is the mathematics. That is what occurs when you actually utilize the regulations instead of complaining about them. Now, here is the part that actually matters. And this is what I want you to remember. The reason most people in America never access any of these approaches is not because they do not qualify. It is because nobody ever tells them that the tax regulations are an offering of incentives. Your high school did not teach you this. Your college did not teach you this. Your employer did not teach you this. Your financial consultant probably did not teach you this either because most financial consultants are trained to sell offerings, not approaches. So the regulations sit there full of incentives waiting for someone to read them. And most people in America never do. Lawmakers utilize the tax regulations to direct capital toward the activities they want more of. Businesses, residential property, power, retirement, learning, conservation, charitable giving. Every single one of those categories has a bright green indication flashing next to it that says, the federal government will compensate part of the bill for you if you participate. The federal government is actually placing its hand in its account and saying, here, take some of this money if you will just do what we are requesting. And most people walk right past the indication and complain about how high their obligations are. The people who construct real prosperity are not the ones who work harder. They are the ones who read the instructions. The tax regulations are the instructions. You just have to stop treating the IRS like an adversary and start treating it like a guidebook. Because once you know the guidelines, you stop playing defense, and you start playing the same strategy the affluent have been playing for 100 years. And that is the strategy where the IRS actually compensates you. And I want to leave you with one more thought because I think it is the most critical thing anyone can comprehend about obligations. Most people think they are paying obligations because they are being punished for being successful. They are not. They are paying obligations because they have not yet learned how the framework was constructed. The framework was constructed by people who expected you to invest in businesses, own property, fund power, save for retirement, and construct prosperity. The framework was constructed for active participation, not passive observation. The moment you become an active participant, you stop being an obligation victim and start being an obligation beneficiary. The IRS is not your adversary. The IRS is an incentive program dressed up as an enforcement organization. The sooner you see that, the sooner you start getting compensated instead of paying. Read the regulations. Employ the professionals who know the regulations. Invest in the things the regulations reward. Stop complaining about the framework and start utilizing the framework. And remember, every single approach I just guided you through is 100% lawful, 100% documented in plain language in the Internal Revenue Code, and 100% available to you right now. As soon as you decide to start participating instead of observing, the IRS is waiting to compensate you. You just have to learn how to request it. One last thing before you leave. If nothing else you take from this video, take this. Every single affluent family you have ever heard of arrived there by comprehending one thing that ordinary people never do. They learned that money is not earned the way most people think it is earned. It is not earned by working harder. It is earned by positioning yourself inside the parts of the tax regulations that lawmakers subsidize. A dollar earned at a W-2 position is taxed at 40%, and then you receive to spend what is remaining. A dollar earned through business ownership, property, or properly structured investments gets taxed at 0, 10, or 15%. Sometimes less, and then it gets reinvested and accumulated for decades. That difference is the distinction between staying where you are and constructing something generational. Make the decision today. Do not wait until next year. Start with one approach, implement it, then add another and another. This is how real prosperity is constructed. One lawful obligation advantage at a buy item